Hey guys, welcome back to another video. Ethan here. So today I wanted to talk about what I think could be one of the best investments, not only for the next year, but possibly the next decade. Now, before I get into this, I want to preface this video by saying I believe in economics, I believe in cause and effect relationships, I believe in history, I believe that what comes up must come down. Before I get too far ahead of myself, I want to say all of this is for entertainment and educational purposes only. Please do your own due diligence when it comes to making investment decisions. I also want to say that although this video may be a little dense, please stick around. It's very informative. A lot of work goes into this, and I hope you guys enjoy. So I'll go ahead and let the cat out of the bag, and then I'll tell you, why I chose this investment. So this particular investment is precious metals, right? Gold and silver, and particularly silver. And I'm going to outline why I believe that. So why precious metals? So precious metals act as a hedge against what people like Robert Kiyosaki and the like call the academic elite. These are your PhDs, that are very ingrained in the financial system, use a lot of MMT, modern monetary theory, and are very theoretically based in their approach to monetary policy and things like that. This is also a hedge against central banks and, of course, Jerome Powell and his money printer. Now, what do I mean by that is basically inflation and just increasing the currency supply, to the moon. Precious metals perform well during recessions. They act as safe haven assets that a lot of the wealthy park their money in to protect themselves, against inflation, against falling, other investments that are falling in price, right? And it's been that way for thousands of years. One of the things that I like most about gold and silver is that they are real money. I got a little definition here. And real money is a medium of exchange, a unit of account. It's portable, it's durable, it's divisible, it's fungible, which means it's interchangeable. And it's also a store of value. And that store of value is probably one of the most important aspects of money. Gold and silver have a finite supply. This goes back to classic economic supply and demand type of stuff, right? When you have fiat currency, which is a currency that's not backed by anything like what we have, the US dollar, you can just print it and print it and print it. There's nothing that's, that it's tied to, like gold. It used to be tied to gold, not anymore. So you can just print it and print it, and there's really no ceiling to how much currency you can create, right? This causes inflation. This causes a lot of other problems. Now I want to take a step back into history and tell you two examples that are pretty pertinent to this. So I'm sure all of us remember hearing about the Weimar Republic of Germany during World War I, when they had rampant inflation and they would take those wheelbarrows full of money and it'd cost $1 bajillion to buy a loaf of bread, right? It'd be super expensive because they were hit so hard with inflation. So I did a little deep dive into this and kind of researched this in one other place. And so I want to tell you about that right now. So a lot of this sprung from World War I, when Germany financed the war with massive budget deficits. Germany then tried to hide the problem of the rampant inflation that was coming through a bunch of propaganda, making it appear that the inflation was not as bad as it was or was going to be. After the Treaty of Versailles was signed, Germany had to pay massive war reparations, and that only added to this problem. After the war, there was great political hostility, a bunch of assassinations, and all sorts of stuff going on. In August of 1921, there was a major political assassination, and this made confidence in the mark drop, the mark being the currency that the Weimar Republic used. Basically, everyone who had foreign currency in the mark were just selling it, just trying to get rid of it. So just for a little bit of context, the price of rye bread from 1913 to 1921 went up 13 times, while in the same time period, the price of butter went up 33 times. Now, this is only the beginning. In 1922, there was the assassination of a German foreign minister. This only added to the political unrest and the confidence in the German mark. During Christmas of 1921, France occupied the area, and this sent the mark into hyperinflation. This is one of the big catalysts that really caused that rampant high inflation that we hear about in history class. This caused food shortages and all sorts of stuff. In 1923, the German chancellor put the country under a state of emergency and moved the German military in to take control over the country and try to regain some confidence in it and the German mark. Now, under military rule, the country began to stabilize, and so did the mark. Then what was to follow was mass unemployment and all sorts of other things that come when you have hyperinflation. Now looking back, some statistics that came out of this, they had a monthly inflation rate of 29,000% and a daily inflation rate of 20.9%. That means that prices of things were doubling just about every 4 days if we use the rule of 72. That is insane. Okay, that was during the 1920s. Is that even gonna happen sometime today? I mean, we're so advanced and modernized, like, is that even possible? Let me tell you about another country. All right, let me tell you about something that's a little more modern, and this time it happened in Zimbabwe. So this one's even more crazy than the Weimar Republic story. At the height of inflation in Zimbabwe in 2008, in the month of November, the inflation rate was 79 billion%. That's not a mistake, billion with a B, 79 billion%. That's crazy, that's 2008. They had a peak daily inflation rate of 98%. So what were some of the causes of this? So they printed money in response to high debt, price controls which caused more shortages, lack of confidence in the government and the economy, and a decline in economic output. Although Zimbabwe is a crazy story and what happened there is terrible, one thing that came out of it that's, I guess, more of a novelty these days are their currency. At one point, they were printing $100 trillion bills. Yes, trillion, $100 trillion bills. You can go on eBay and buy these things. Now, obviously, with inflation like this, it destroyed savings, destroyed businesses, and the cost of goods. Now, I tell you these two examples to remind you that this isn't something that's just happened in the past and that this could happen today. Maybe not in the extent that it has happened before, but it's still a possibility. And during those times of hyperinflation, one of the only things that could help you survive something like that is through holding gold and silver. Another reason why I like gold and silver as an investment, particularly silver, is that it maintains its purchasing power, right? I touched on this a little earlier, but I'm gonna go a little more in depth here. So there's this idea that gold and silver maintain their purchasing value over time. There's this example that's used often a lot about the 1 ounce of gold dressing a nice man. So if you go back to ancient Rome, the idea was that 1 ounce of gold could give a man a nice toga and his sandals, whatever, just dress him. 1 ounce of gold could give him a nice dress. Today, 1 ounce of gold can give a man a nice suit, right? You have your suit and your shoes and your accessories and whatnot. But to a large extent, that remains true, right? An ounce of gold will dress a man. And so what we're looking at here is it's maintaining its purchasing power throughout time, not so much appreciating in value, but maintaining its purchasing price, although it may appear that way on the surface. Now, I thought of another example here. So say you have $5 and we go back 100 years, right? We're gonna go to 1920. In 1920, on the low end, a gallon of gas cost you 21 cents. So your $5 could get you roughly 23 gallons of gas. If you held that $5 all the way to 2020, 100 years later, that same $5 will get you about 1 3/4 gallons of gas where I live. Gas where I live is about $3 a gallon. So that $5 back then could get you 13 times more gas, right? It could more than fill your car. Let's take a look at gold during the same time period. So if we look at gold in 1920, the average price was $20.67. Now this example is a little unfair because the price of gold was pegged. It was fixed. The free markets were not working on gold during this time period. This isn't a super fair comparison, but we're just gonna run with it because it still illustrates the example that I'm trying to tell you. If we look at gold in 2020 dollars, it's at the time of this video, it is $1,880. In 1920, our 1 ounce of gold will get us 98 gallons of gas, right? $20.67 divided by 21 cents per gallon gets us 98 gallons of gas. We'll call it 100. In 2020, where I live at $3 a gallon per gas, our 1 ounce of gold will get us roughly 626 gallons of gas. So if you look at the surface at the price going from $20.67 an ounce to 1,880, it looks like a massive gain. Well, let's dig a little deeper. So if you look at the $20.67 to the $1,880, that's a 90x price increase. But if we look at the value and the purchasing power only went up roughly 6x, right? 100 gallons of gas to roughly 600 gallons of gas, right? It only increased sixfold. So on the surface, this looks like a massive gain, but when we dig a little deeper, we see that this tells another story. So we want to measure things in terms of value and not necessarily price. And gold and silver are what are going to give us that value. So I believe that the next asset that's going to be on the receiving side of this wealth transfer is going to be gold and silver. And this goes into another thing called cycles and cycles investing. So precious metals and stocks they have an inverse relationship with each other. So the idea is when stocks go up, gold and silver tend to go down. When stocks go down, gold and silver tend to go up. And so the idea is to switch in and out of these asset classes, and your appreciation will be a whole lot more, right? Your gains that you realize will be a whole lot higher than if you just stuck into one asset class. So now I want to talk a little bit about the scarcity of these metals and some of their industrial uses. So gold is more rare than silver in the crust of the earth and when we're extracting it through various mining processes. But when we look at above ground stores, gold is 5 to 7 times more abundant above ground than silver. So why is this important? The mining process is very labor and money intensive, and there's a lot that goes into it. It's a very energy intensive process. Extracting the metal out of the ground is a whole lot more difficult than just having it sitting above ground, obviously, right? And so we're often taught that gold's more scarce than silver is, but above ground with the supplies that we have, silver is actually the more scarce element. So I want to tell you a little bit about the gold demand distribution in 2019. So in 2019, jewelry accounted for about 48.5% of global gold consumption. Investment was 29.19%, central banks was 14.84%, and industrial demand was 7.48%. Now let's look at silver. For industrial demand, it took out about a little over 60%, with 10% of that coming from photovoltaics. Now, if we look at investment, it was 21.6%, jewelry accounted for 20.3%, silverware accounted for 5.4%, and photography, I thought this one was kind of odd, was 3.4%. So from this, we can see that silver has about a little over 6 times more of an industrial demand than gold does. So why is this important? There are certain processes and things that are manufactured that can only require silver. And if they don't have that silver, it doesn't get made. So silver is a very important metal when it comes to producing and manufacturing things, right? So industry is going to need that silver, right? 60%, that's a huge market share. Whereas when we look at gold, it's only 7.48%. And so in silver, not only do we have investment demand, but we also have a greater industrial demand. And so that industrial demand is something that I think is going to be a big catalyst for higher silver prices. Now, why is silver going to outperform gold? So there's something called the gold to silver ratio. And this is how many ounces of silver it takes to buy 1 ounce of gold. So over the last 100 years, that ratio seems to be about 50 to 60. So it's going to take 50 to 60 ounces of silver to buy 1 ounce of gold. So over the last 100 years, that ratio has averaged between 50 to 60, with a low of 14 in 1980 right around, and a high this year in 2020 of about 124. So just looking at the numbers, we can conclude that not only are precious metals undervalued compared to everything, but silver is undervalued compared to gold. And we can do this from the ratio. So if we're sitting at 73 right now and the average is 50 to 60, we still have room for that ratio to go down to the point where gold and silver equalize to that average ratio. So when we look at this from a value perspective, we can get a better idea of what we're looking at here and the potential in this. So I'll give you an example of trading the ratio and how this could be to your advantage. So say we buy in and we buy silver when the ratio is 100. So it's going to take 100 ounces of silver to buy 1 ounce of gold. So at that time, we could either choose to buy 100 ounces of silver or 1 ounce of gold. But since the ratio is at 100 and averages between 50 to 60, we know that silver is the better value because we'll be able to get more gold later when that ratio drops. So say later on that ratio drops to 50. So it's going to take 50 ounces of silver to buy 1 ounce of gold. So since we bought 100 ounces of silver in that first example, we're now able to get 2 ounces of gold because the ratio is at 50 and we have 100 ounces. We're now able to get 2 ounces of gold for what cost us 100 ounces of silver earlier, when we could have either gotten 100 ounces of silver or 1 ounce of gold. Now that can be kind of hard to follow if you're not used to the ratios and how this, how this process kind of goes. But the idea is that if you trade this ratio in this way, you're going to end up with more stuff. So because we traded the ratio in that way, when the ratio was high, we bought silver, and when it was low, we traded it in for gold, we were able to get twice the amount of gold than we were originally able to get. Now, going along that same line of thinking in terms of value, another thing you could look at is the gold to Dow ratio. So this is how many ounces of gold it takes to buy 1 share of the Dow. So currently, the Dow is trading at roughly 30,200, and an ounce of gold is at 1,880. That's roughly 16. So it's going to take 16 ounces of gold to buy 1 share of the Dow. So if we look back historically, in 1980, there was a low of 1.5, so 1.5 ounces of gold to buy 1 share of the Dow, and a high in 2000 of over 40. So when these numbers are high, that means the stock market's overvalued, and when these numbers are low, it means the stock market's undervalued. So looking back historically, when this Dow to gold ratio is 4 or less, gold tends to be overvalued and stocks tend to be undervalued. And when this ratio is 10 or greater, gold is often undervalued and stocks are overvalued. And so the idea is that you can trade these ratios and end up with a lot more stuff at the end, right? You're going to have a larger quantity of whatever, a larger unit of whatever it is that you're doing this trading with using this ratio. And of course, we're in turbulent times. Gold and silver tend to act as a hedge against recessions, depressions, all sorts of things like that. And so that money flow that transfers into those safe haven assets, gold and silver, are what tend to increase the prices. And like what we were talking about earlier, is gold and silver tend to just maintain purchasing power, right? If we were to graph, gold over time and its purchasing power, it's more or less going to be a sideways line that kind of does this thing. It's not like a stock or something like that. Maybe you're saying, I want to have that big appreciation, though. I don't want to just maintain what I have. I want to grow it. Now, gold and silver tend to overcorrect themselves when this wealth transfer does happen. So you're probably going to do a little better than maintain your purchasing power, even though you may have, circumstances where you could have lost a whole lot of money if you had it in the stock market, whereas you'd maintain it or more than likely do well, a lot better. It's all relative. It's thinking in terms of value than if you were to just have it in the stock market. So what happens if a buying panic ensues, right? Say stuff hits the fan, right? Stuff hits the fan, people are concerned, everyone starts rushing into safe haven assets. Maybe gold just starts to moon, right? What's the next thing they're going to be looking at? The cheaper alternative. That cheaper alternative is going to be silver. What's going to happen when large institutional funds start pouring their money into gold and silver? Typically, these large funds hardly have any of their money invested into gold and silver. They tend to be very overweight in stocks and paper assets and not really hard assets like gold and silver. Usually they don't do more or exceed more than a 5% allocation to gold or silver. Let's talk about large funds for a little bit. So Ray Dalio's Bridgewater Associates, they purchased $400 million in gold ETFs in Q2 of 2020. The Reserve Bank of India said it would increase its gold reserves by 3.5%, which would be roughly $18.9 billion worth of gold, which accounts for 56% of all of 2019's gold investments globally. And then we have Blackrock, the largest asset manager in the world, with $7.4 trillion worth of assets under management, was the second largest buyer of silver SLV shares in Q2 of 2020, buying 5.4 million shares. Now, if these big funds, that have trillions and trillions of dollars, combined of assets under management, do something like a 1% allocation or a 2% allocation or even a 5% allocation to gold and silver, particularly gold in this example, I know in the 1% case, they would buy, if they just allocated 1% of all their assets to gold, they would buy over 4,000% of all of the investments that were made in gold in 2019. And if they allocated just 5% of all the money they have into gold, they would buy over 20,000, I think it was 28,000% of all the gold that was bought for investment in 2019. I'll put a link down below that links to that article. Please check it out. It's really interesting. All right, I got a little bit of a theory. Maybe I'm going on a little bit of a limb here, but look at who talks about gold and silver, right? Who are the people that are invested in gold and silver or talk about it as an investment? They're the old timers, right? These guys have been around the block once or twice. They have a lot of experience. They've seen things. And, I think they know something I don't. Obviously, I research so much about this stuff, but they always tend to move towards sound money, which is gold and silver. And they talk about gold and silver, hoarding it or whatever. But I think that, they have experience. They've seen these things before and they know what happens when stuff hits the fan. And that's why they think that gold and silver, in my opinion, that's why they think gold and silver are those investments to have during times of uncertainty. So what about Bitcoin? And don't stocks only go up? Let's talk about that. So what about Bitcoin? Bitcoin's had about a 12-year history since 2008, right? I would more so call it 3 years at least since it's been in the public. Since 2017, that's really since when Bitcoin took off, right? Try getting a mortgage in Bitcoin or a car loan in Bitcoin. I think the federal government's going to have a little bit of a problem with people trying to do stuff like that. What about getting paid? What about taxes? And so I don't think the federal government's going to jive too much with that. And so that's why I think something like a CBDC, a central bank digital currency, is probably something that's a lot more realistic than having, say, Bitcoin be that thing. Now, don't get me wrong. I think Bitcoin is a great thing. I'm all for it. Decentralized currency, count me in. I think it'll do very well over the long term. Is it in a bubble? Maybe, possibly. Do I think it'll do well long term? Absolutely. Do I think we're going to be using it every day, in transactions and things 10 years from now? I don't know. It acts very much like gold and silver in that it's something outside of the financial system. I like that about it. There just isn't that proven track record so much for me. We saw in 2008, or we saw in 2020 when we had we had that global illness happen. Cryptocurrency tend to track with the stock market. I didn't like so much that it tracked with the stock market as much as it did, as much as it was correlated. One of the things that I really like about gold and silver is its track record is thousands of years, right? This stuff is proven. Now, what about stocks? I do think, in my opinion, I think stocks are in a bubble. Is it going to crash? I've been hearing just about every single day since 2016 that the stock market's going to crash. If I held on to that, and if you knew that and you didn't invest at all, you would have missed out on massive gains. But I think especially today, we have way too many catalysts pointing towards not only is this in a bubble, but this thing's gonna pop. The Fed has added trillions to its balance sheet just this past year, right? They are printing currency to oblivion. We had the black swan event and illness that's continuing today, right? The global health crisis. We have near zero and negative interest rates in parts of the world. We have mass unemployment going on. We have people defaulting on payments. We have businesses that are treading water right now. And all these zombie companies. We have mountains of consumer debt. Now, it is important to remember that the economy does not equal the stock market. But honestly, guys, I think we're reaching a critical mass here. Being in gold and silver, whether the stock market crashes in 3 months or 3 years, I'm able to sleep soundly at night. And that's what I like so much about gold and silver. It's going to protect me and protect my downside. What's the worst case that happens when you own gold and silver? You maintain your purchasing power, right? So in my opinion, there's not a whole lot of downside when it comes to investing in gold and silver. Now let's look at real estate. So right now you have tenants that are going, very long periods of time not having to pay rent. Evictions, you can't be evicted, all sorts of other things going on. Being a landlord is not the best thing right now. Now, don't get me wrong, under the right conditions, I think every one of these assets that I've mentioned, stocks, precious metals, real estate, and cryptocurrency will all do extremely well. But right now, at the current time period we're at, I think gold and silver present the most upside to an investor at this point. Now, one of the unfortunate things about being a precious metals investor is that if you're long gold, you're short the dollar. Right? And no one wants, unemployment, depressions, recessions. No one wants any of that, right? This is just the nature of the beast and how things go. And what comes from this is you want to be able to protect yourself and protect your wealth, not only for yourself, but for generations later on. You want to be able to, inform yourself and be able to protect yourself against what's, inevitable. Right? I've been investing in precious metals since late 2017, early 2018, and I bought the thesis then, and I buy it even more today, right? Maybe I'm wrong, maybe I'm crazy about this, but the thesis, the facts, everything that points to where we're headed and what could happen with gold and silver is just too overwhelmingly obvious to me that I can't ignore it. And I try to be as objective as I can looking at these things and trying to look at different angles, because at the end of the day, we want to make informed, objective investing decisions, right, when it comes to our money. And so that's what I've done. I try my best to educate myself against, both sides, the bull case and the bear case. And when it comes to gold and silver, there's not a whole lot of holes that I can poke in the thesis for this. And so my plan is to do more videos and, like I said, dive into the nuances of this kind of stuff and provide you guys more of this content. I don't see a whole lot of people my age talking about gold and silver. Older people tend to talk about it. I want to normalize it for our generation because I believe there is a wealth transfer coming, and I want you guys to be on the right side of it. And so I think that's going to do it for this video, guys. Thank you so much for watching to the end. I put a lot of research and work into this. It means so much that you stick around, and if you find value out of this, please go ahead and give it a big thumbs up. Thank you guys so much. Subscribe if you haven't already, and I'll see you guys next time. Take care.